All right. Welcome, everybody, to episode 280 of SF Live. I'm Patrick Karim, co-founder of Badcharts.com, and I can't wait to speak with Kai today.
Fantastic. Patrick, best intro we had on the program so far. Much appreciated. Thank you so much. Thanks for coming back on. It's great to see you again, my friend.
Yeah, same here, man. It's I'm always happy when I get an email from you guys and say, oh, it's time to catch up. So
Oh, it
it's time
definitely
to
is. It definitely is time. It's always great to hear from you as well, because I'm quite intrigued always by your technical analysis and what you're working on there on the chart from a chart perspective. Because we've established in previous conversations, you're not emotional. You just look at the stats. You don't factor in any emotion. It's really pure the technical part of it, right? And I think we should dive right in. You've been a frequent guest, so we don't have to introduce you much. And I just want to dive right in because dive one into your Twitter charts here that you've published, and it's about buying the dip in gold and silver miners. And I think we need to discuss that because the summer, especially right now, this week, last week, feels super slow in the markets. Gold is being hammered down. There's zero momentum. Newmont just put out some very poor numbers again today as well. When do you think it's time to buy the dip? Is it time to buy the dip, or are we just being all faked out here?
Well, it's not exactly like buy the dip on the daily chart. So what's happening right now is we're approaching when you look at technical analysis and you weigh the evidence, we're starting to approach really a period where this could be the capitulation bottom, like, I don't know, maybe 1 month, 2 months, 3 months away max, but we're way, way closer to a capitulation bottom than we are at a meaningful top where we ran, where gold was outperforming SPX for 10 years, like in the 70s or like in the 2000s, where it's complete opposite of that. So that chart where you have highlighted, that's the ASA Precious Metals Fund. That's like the oldest precious metals fund of gold and silver miners, like I've been recommended to use. It's from 1968. And that's important to have that data going back 2 cycles, not just the 2000 cycles, but also how did the miners perform as a whole, not just Newmont, where I know we have data going back all the way back then, but as a whole, how did these miners perform back in the 70s? Because a lot of these miners in that fund, they don't even exist anymore. It's like the SPX 500, right? They get rotated out. So it gives you a good clue. So right now, it's all about what's the macro structure are we in? Is our capital flows leaving the SPX to go in commodities, inflation sensitive assets, or it's the opposite? And that's defined by the upper line. It's the SPX divided by the PPI, producer price index. So every time SPX has broken down through a meaningful trend line, rising trend line, and it's done its 10, 20-year bull run, and it breaks down versus PPI, that is where the dynamics change. So instead of looking to sell the rallies in the gold and silver miners, that's actually periods where once the miners hit important support, huge retraces, we know the miners super volatile. And once they hit important support, which is previous resistance, what I call a wall. So once you bust through resistance, now that becomes a support level. Those were historically time to buy. You could see in the 70s when it broke down SPX versus PPI. So now we're in the macro capital flows going to miners. Every one of those dip downs were occasions to buy the dip, especially that one in the mid cycle in the 1976. I think it's almost a perfect analog move. Then today it goes up, stagnates, and then goes down, hits the breakout line that happened years before, and after that it shot up. And as soon as we're out, as soon as the SPX starts outperforming the PPI, then it's not time to do that anymore. Now you buy the dip in US growth stocks, and you see that after that, the gold and silver miners, they just stagnated during the whole 80s. And then after that, they even dropped in the late 90s until they created a new base. And then SPX broke down again versus PPI. And then each of those dips had to be bought. You see, even that 2008, look, there's a lot of analog moves. The 1976 crash, the 2008 crash kind of looks like today, right? It retested the breakout line that it did back in 2003 or 2001. And look, we're right back there. So that circle, there's still a few months. We're still not at that line. So it could dip below that line. And even on the smaller timeframes, it could really the gold silver ratio could spike up. It could really dip below and then but close the quarter or the month above that line. And that's probably going to be the safer time to say, okay, buy that dip. We've turned the corner. We closed back above that breakout line. We left a wick, capitulation wick under. Now Okay, let's do it, guys.
Um, coming to inflation and looking at the miners buying the dip, maybe front running the price action a little bit already. Looking at the Newmont numbers, I just mentioned Newmont before. There's a lot of inflation pressure on their all-in sustaining cost for per ounce of gold produced. A lot of it is higher energy costs, meaning fuel and fuel input costs. But the oil prices tanked quite a bit. Do you see those in your technical charts already? Like you use the PPI, the Producer Price Index, sort of for comparisons. Do you see that? Like if you forecast a little bit, do you see the PPI coming down, or even the cost of goods input into those prices? Do you see that happening already?
Yeah, well, that's why you have to look at the you use oil in your ratios right now. So then there's a miners to oil ratio, or I did when the oil explodes up, it really hits hard the US growth stocks, hits the miners also. But as soon as that oil price goes down, then after that, the miners have some room to go up on the recovery phase. Because what happened in 2000s is when the US SPX did a recovery phase, so a bear market rally versus the PPI. So like you've seen it a few times, we were below that PPI line, the SPX divided by PPI. Every time the SPX has like, okay, maybe things are getting a little bit better in that inflation cycle. Silver has done well, gold has done well, the miners have done well. They don't want the US equities to crash, unless in the 1970s, we could look at that also. In the 1970s, SPX was going one way, and it did not drag down gold and silver. They went the opposite way. That's how it was in the 70s. In the 2000s, it was the opposite. So when the US equities were going down, they brought down gold and silver. And on the recovery phase, when the SPX was recovering, miners, silver and gold recovered faster. And that's where you made more money being long those. And as soon as as the gold silver ratio unwinds, the DXY unwinds, and the market are pricing out a market crash or like something really severe, or they're starting to price in rate cuts or rate flattening, then the SPX is probably going to recover, but the gold, silver, and the miners will recover faster, because we are in that macro landscape where there's still macro overbearing inflation that's going to hurt more the growth stocks, even if they try to recover within that SPX divided by PPI defined inflation cycle, and then they're going to crescendo upwards, creating higher lows. So yeah, it's like levers, but because the SPX has broken down versus the PPI, the gold, the precious metals complex will lockstep higher and outperform the SPX growth stocks during the next 8 years, until SPX outperforms PPI once again, and then we flip the script. It's over, guys, for the miners. As soon as SPX is able to outperform PPI, you cannot be long miners anymore. The capital flows are not going to go in the miners. They're going to go back into growth stocks. Economy is better for like a meaningful way. Inflation subdued. So that's when we're going to exit. But right now, the SPX just broke out, I think, a couple of months ago versus the PPI. So it's just started.
Yeah, you mentioned the PPI, and you have another chart here on Twitter. It's about the truck price index, and I find that really interesting because I had to sell a car in Vancouver the other day, and it felt like the market completely disappeared on me trying to sell the car. There's very little interest, despite on what I'm seeing online and hearing. So I was like wondering if that bubble is about to burst, and whether a recession is actually happening with slowing down consumer interest. What's your opinion on that?
Well, I think if we're not in a recession, we're super close to recession. Like every time, there's another chart I did where when the SPX breaks down versus the PPI and has huge red candles, like practically before, during, or after huge periods of recessions, because every time the SPX broke down versus the PPI, we've had 2, 3, or 4 recessions. And while the SPX is outperforming the PPI, we've had one tiny recession. There's less probabilities of recessions when SPX is outperforming PPI. So for that truck index, that's one component of the CPI, which is those used car prices. So yeah, they broke out of what was that, a 40-year base, 25-year base? It broke out. So of course, sometimes it's not going to be in a straight line, but now that breakout line is support. So yes, there could be like a slowdown. And right now, if we're in a recession and there's possibility of a market crash, and that's what the SPX is telling us, we're going to probably retest that breakout line. And then when everybody thinks it's the end of the world, going into depression, well, the spigots are reopened by all central banks. And then after that, we go for another write up, but we're not going to reach those lows again. Yeah, this one.
That's the one. Yeah, I was just looking for it.
Yeah,
that's the chart with the various recessions highlighted in there as well.
Yeah, look at those huge drops. 2008, there's multiple quarters of recession, and we only know in hindsight. And I'll tell you one thing: silver and gold will bottom pretty much at the worst of the recession. So when we're like at the abyss of the recession, like half before it even starts recovering, gold and silver know, and they're going to start recovering way before they tell you, before the FOMC tells you. They could even start recovering before they tell you we're in a recession. It's crazy like that, So because those numbers, you see that those green bars, they came from Fed data, but the Fed's always, you know how it is. Sometimes I think even in 2008, they said the recession started in mid 2007 or something. And it's like, but the metals in 2007 or late 2007, silver was not able to do a new high. They were always already telling you, look, something. You got to listen to the precious metals, man. They're the better economists than any economist out there. Sorry, guys.
Yeah, absolutely. That's why Dr. Copper is Dr. Copper. It tells you exactly, or it tells you exactly how the world economy is doing, right? So that's why we've seen a massive dip down to 350 on the copper price as well. I'm not sure, like on Twitter, I didn't see a copper chart, but I think we should talk about the metals themselves. You mentioned gold and silver as well. Where is gold right now? It seems like it's fighting quite a bit of an uphill battle, but it's holding that technical level at 1680. That important mark, it seems. Do you have some more insights for us there?
Yeah, well, gold lost its trend line. So right now, it's always the first trend line to break is the slanted trend line, right? So it breaks that down, and after that, what people do, they look at the next horizontal support, and if that breaks down, then it's that's the final breakdown line. Then after that, it goes much slower. Usually, it does a reverse symmetry move from where it begins. But that's when you have to look at gold breaking down now in the context that it's doing this move down, but with the SPX underperforming, breaking down versus the PPI. It's not the same as 2011-13 when it did the same type of breakdown, but gold had a 10-year run. And that's what, back in 2013, that's when the SPX had started breaking out versus the PPI. So the context is completely different. I'm looking more at an analog move closer to what's happening in 2018. So in 2018, you see gold, it was like from 2015, 17, there's like a rising trend line. It breaks down below that 3-year moving average, below that rising trend line. Everybody thought it was the end of the world in 2018 for gold. Oh man, it's failing. But after that, Powell pivot, the 30-year divided by the 10-year yield started rocketing upwards, which now it's starting to turn upwards. And after that, gold didn't look back. So I think we're more analogous to 2018. So now it's going to be like a false breakdown. Gold will not go as low as what people have, $900 targets, or even going back to 1350. That's a big stretch for me. Maybe on the smaller time frames, it could go down crazy. But because of the macro landscape, because the SPX again is underperforming the PPI, then this is going to be probably the last greatest dip, buying the dip. And you know what? Gold, the price, you could scrap everything away. Gold will tell you anyways when it's time to go. Just like it broke out in June of 2019. All people have to do is just wait for the gold chart to break out through a descending trend line. And as soon as it closes above on a monthly close basis, then gold's telling you all you need to know about everything. So it kind of makes TA boring, but it's good to understand, not to get scared, to understand where this price action breakdown in gold is happening. Is it happening after a 10-year bull run, or is it happening at the beginning of a breakdown of growth stocks versus inflation?
I was going to say I must have missed the 10-year bull run, so it must be B, answer B. Some more of a breakdown of the growth stocks. So I pulled up a chart here from your colleague Northstar Charts, who you work with together, and he says 1680 is that critical level. And do you see gold breaking down any lower? Like, is it really supported volume and everything? Like when you put your technical analysis on it, is 1680 that critical level? And what happens if we actually do break below?
Well, if we have a monthly close below 1680. There's a reverse symmetry move that brings it back down to that dotted line at 1350 or 1400. So technically, if you just look at the chart, that if it breaks down, closes below 1680, the next, because as fast as it went up, there's a vacuum on the way down. There's practically no buyers on the way up. Most of the buyers are at 1400, 1350 in that base. So that's the target. That's the classical TA target. If it closes below 16 or that line he put, then the target is all the way down there.
Gotcha. Ooh, sounds scary. We don't want to think about that, especially with all the other commodities still high and inflation still being rampant here as well. Curious to see what the Fed does this week. You mentioned the Fed fund rate and the Treasury bond yields, the 30 and the 10-year-old. When you say the ratio, when you divide the 10 by the 30-year-old by the 30-year Treasury bond yields, what does that tell you, and what does that exactly mean?
Well, I don't know if you have a chance. Kevin posted one recently, which I retweeted. It's
Let me find it real quick while you chat.
yeah. So essentially, look, we're just looking for ratios. Like I'm not an economist or a fundamental guy who could explain to you why, when the 30-year yield starts outperforming the 10-year yield, but if you overlay that ratio since at least before the early 2000s, and then you overlay the gold chart with ratios, often they oscillate. So it gives you, it's like an indicator. And then after that, you could overlay the price of something, and then you could see the reactions and the probabilities. So every time that happened, let's say it happened 100% of the time, then the probabilities are that if it does that move again, there's a high probability that that will correspond and move upwards. So when that 10, that's the one on the 4-hour chart, which looks a lot like the 2018. So every time the 30-year was underperforming the 10-year about to these levels, 1.06 or 1.08. That's a historical trend line, support line, like that goes all the way back to 2000, even further back. Gold was starting to put in the bottom. And after that, once that broke out to the upside, then gold was fuel for gold, then it shot up. And gold peaked in 2020 when that ratio was sky high, when the 30-year were outperforming the 10-year by too long of a stretch. Gold top, that fully reset. But what's important is that ratio fully reset back to its historical support line. But gold did not go back to 1,300 or 1,100. It was the last time it touched that support line. It's perched higher right now, right? So it goes up, corrects, that ratio resets. So the spigots or the FOMC, the market already now, it's starting to price in that's about to flip, right? Because we see in that chart, the 4-hour chart, and even recently, the 30-year is really, really on that breakout line. So once we break out above that, it's recovery mode for everything, but gold will outperform SPX and growth stocks on the way back up on that initial burst there, and we'll have to start pricing in that recovery.
Yeah, you mentioned gold was breaking out while silver actually couldn't really follow suit before. Let's talk about that gold-silver ratio real quick. Like, how do you see silver performing, and how do you see that gold-silver ratio performing in the long run?
Well, right now it's going to go to a crescendo epic move where everything's going to be blowing up. So until we get a wick, like an upper wick on the monthly candle. So a wick, guys, is the price action goes up. During the month, you have a full candle. But by the end of the month, the sellers come in and say, guys, like, this is too much. Then we have to start pricing it that we've exaggerated. It's not that bad. The Fed's going to step in. And then the sellers come in, and then it creates a wick. And that, what it tells you is a capitulation. It's an exhaustion wick. We've seen it in 2008. We saw it in 2020, 2003. Dot-com bubble, it kind of was more smooth, the transition into a precious metals bull era. So the gold-silver ratio is highly inversely correlated to silver. So it's practically silver moving the gold-silver ratio inversely. So every time that gold-silver ratio drops, silver generally goes up higher. So this is I see that as another fuel reservoir. So that's going up, crescendoing up. Silver, a lot of pressure on silver. Silver getting sold more than gold. It's risk off. It's recession. It's like the end of the world. We're like approaching that. It's like you're pressing something hard. It will squirt up. But after that, when it's the end of the world, people are looking at $5 silver. Let's say it drops to 15 intraday or 11 intraday. People are going to be looking at $5 silver. It's deflation. That's probably where it's going to start unwinding and have a rising trend line for those who want to be safe. Until the gold-silver ratio, guys, goes back below that rising trend line, just wait. It'll tell you, gold-silver ratio will tell you when it's safe to step back in, right? So we're getting close to there. I don't know how high that thing's going to burst up, but we're getting closer to resolution than not have a resolution, especially at the angle that thing's moving up there. It's either goes up to the sky and it's total systemic craziness, or somebody comes and saves the day.
Let's hope somebody comes and saves the day, to be honest. Like, let's keep it real here. Like, what is the level you're looking for on that gold-silver ratio for us to step back in and start looking at silver?
That's the 220 was the highest ever. So this you overlay the DXY, it looks practically the same. So and the VIX is crushing those up. I don't know how high it's going to go. It could, I think it could surprise us on the way up, this thing there. So if gold goes down to 1,400 and silver to $10, that means it's going to be 140 to 1, right? It could just like go crazy. But because I'm looking at the bigger pictures, I'm not scared of that. I actually I've been accumulating cash for a long time, not proposing new trades for our members. So this is the time to just get really ready, let the market do whatever it is. And the cheaper silver gets, the better it is for us to buy some, get more ounces, man.
Yeah, no, absolutely. You mentioned you're building cash, so sort of maybe as a last question, what do you recommend, or no, not recommend? Like we're not dishing out financial advice here, but like in the next 3, 4, maybe 6 weeks, even until summer break is over everywhere worldwide, what do you recommend doing?
Well, look, since 2020, the breakout in the metals, breakout in the gold miners, and after that, after they peaked out in 2021, there was a lot of sell signals because they were closing below their 12-month moving average, closing below the rising trend lines. I call it sleep mode line. So since then, if there's nothing new to put, well, whatever other revenues that's starting to feed your NAV, your net asset value is starting to grow. Well, you can't allocate money in stocks that aren't breaking out just because you want to play something. So your cash fund should be growing, right? Or you've been closing positions and growing that cash fund. And for me, you need something. Either if you don't want to hold cash, you could hold gold in the meanwhile, and then after that, resell your gold, convert in fiat, and then buy whatever you want. But definitely, emotionally, it's always great to know you have a good reserve of cash. So especially when you see that GSR going up, and you see previously that led to huge sell-offs. If you want to be able to take advantage of those crazy sell-offs, or have some, or even if you don't want to catch those spikes in the GSR, then at least on the way back down, you're not fully invested and you're not just waiting to break even, right? You have cash to actually buy miners really, really cheaper as the gold silver ratio unwinds. And yeah, it's good for emotional reasons and for tactical maneuverability. Always good to have cash with.
Always good to have cash. Fantastic. Patrick, thank you so much for joining us today. I really appreciate it. I know the Solomon doldrums are wearing heavy on everybody, but you're a bright light here. So thanks for that encouragement, and not for talking like just negative. I think there is positive upside here and a massive pressure building in the markets for us to profit.
Look, people, it's crazy. It's human psychology. When silver was going crazy, people just they came to follow me on Twitter because they wanted, oh, what's the next target? Everybody was looking up. And now price action is going down to critical historical support in a macro environment where SPX is breaking down versus PPI, and people are looking for targets even lower. It's crazy human psychology. It's like, I'm not saying to catch a falling knife, but I'm telling you, we're much closer to a bottom than a top. And people, they're just seeing the dark when it's dark, and they're just seeing the sky when it's sky. And you got to flip if you want to make money, you got to flip the script on that, because you won't believe the next breakouts. You can say, it's going to fall. Miners suck. They keep diluting, but you're going to miss the boat.
Absolutely. No, thank you so much. Really appreciate. Always great having you on, Patrick. And you're on Twitter, obviously, at Badcharts1, and you've been wearing the hat. NorthstarBadcharts.com is your new website, the project you're running with Kevin. And everybody go, please visit the website, sign up for the course. I think it's fascinating, super interesting courses you're offering there on the technical analysis of the markets, and without the emotion, which is important. So to keep a clear head. Thank you so much, Patrick, and we'll be back with more. And just a quick reminder, everybody, make sure to follow us on YouTube, follow us on Twitter, hit that like and subscribe button, and leave a comment. What do you think? Is gold breaking out, silver breaking down, or what is happening? Let us know, and we'll be getting back to you in the comments as well. Thanks so much, and we'll be back with more soon. Thank you.